Okay, we go to introduction to liabilities. Now, as a start, let's define liabilities based on the revised conceptual framework. So, it is a present obligation arising from or of an entity to transfer an economic resource as a result of past events. Now, um, there are three characteristics that we need to check here. Number one is um, the present obligation. No? So there should be a present obligation. So there are two types of obligation in this manner. So number one is our legal obligations. Number two, constructive obligations. So when we say legal obligation, these are obligations that are enforceable by law. So I believe it is defined in our civil code. What are the things that give rise to an obligation? So it may be from law, contract, quasi-contract, delicts, and quasi-delicts. Okay, and that is thoroughly discussed in your obligations and contract. So most of liabilities are from legal obligations because in most cases obligations are bounded by contract. So let's say for example notes, no? So if I borrow money from you and then you issue a notes payable or a promissory note, then that is contractual. Okay? So since it is contractual, that is a legal obligation because it is under contract. Okay? Now, number two, constructive obligations. So, constructive obligations, these are obligations because of normal business practices. So, what are examples of this? Now, examples of these are provisions. So, provisions are types of liabilities that are probable and can be measured reliably. Okay? So, the difference between the normal liability and provisions is that normal liabilities, their amounts are determinable. So, if I borrow you 50 pesos, then my liability to you is 50 pesos. It is determinable. But for constructive obligations, specifically provisions, the amount is an estimate. Okay, so my liability to you is not exact because it is dependent on the happening of an event. Okay, so what are the examples of this? So let's say for example, um, you buy a when you buy a gadget or gadgets, no, most of them have warranty, okay, or warranty period. Now, if I'm the seller, okay, and I sold to you a gadget and then I provided, let's say for example, there is a 2-year warranty, okay. Now, on my part, there is an estimate, okay, or there is an estimation that in the future, um, there is a chance that someone will claim their warranty because it would be what do you call this? It would be moronic to think that um, my product is perfect. So of course nothing is perfect. So if I provided warranty, if I sold 100,000, then of course one of the even one of those or two or okay. So whatever my estimate, there is an expectation that someone will claim their warranty. So from there, I can estimate an amount that if I sell and then I gave them warranty, I will think to myself, oh, in the future, there may be someone who will claim their warranty. And if they claim their warranty, this is the estimated amount of expenses that I will incur. So, is my estimate under the law? No. It is from constructive obligation. It is a normal business practice. Warranties are normal business practices and it is good for customer relation. Okay, so I've estimated an amount that I will pay in the future. Is that allowed? Yes. We can estimate expenses. Okay, but we cannot estimate income. Okay. Now, since liability, warranty are in the future, that is a future expense, we can estimate that. So that those are constructive obligations. Next obligation is to transfer economic resources. Now, this is self-explanatory. Of course, if you have a liability in the future, of course you have to pay or to settle. You have to pay. Okay, you have to pay an asset or you have to do services. Okay, now one thing that should be that have to be understood in this transfer of economic resources is it is important to know that someone will transfer economic resources that someone has to pay. Okay? Now, it is not important whom do I have to pay. Okay? So, example of this. Now, if I have an accounts payable, of course, I'm the one, we all know that I'm the one who will pay. Okay? And the one whom I'll pay is whoever I borrowed money from. But there's some instances where you don't know who you're paying. It's just that you know that in the future you will pay a certain amount. So what is an example of this? As I've said earlier, estimated liabilities. So let's say for example, I sold a gadget. I have 1,000 units of sale. Okay. So I have estimated that in the future there will be a settlement. Okay, or there will be someone who will claim their warranty. Now, do I know who that someone is? Of course not. But I have estimated that there may be someone in that 1,000 people that I have sold. Okay, I don't know who the exact person is. I just know that in the future I have to pay. Okay? So, yan, obligation to transfer resources. Number 3, the liability arises from past events. So, something happened in the past that gave rise to that liability. Example, accounts payable. What gave rise to an accounts payable? Purchases. Okay, someone purchased and he did not pay. That's why there is an accounts payable. So something happened in the past for an obligation or for a liability to exist. Okay? Now, we go to the liability recognition principle. Now, when we say recognition or recognized, okay, we mean that, okay, this is the term where we say it is included in the financial statement. Now, for liabilities, we specifically say that it is recognized if it is recorded in the balance sheet. Now, for it to be recorded in the balance sheet, a liability should be probable, and number 2, it should be measurable. So, those two must be present. So, how do we know that the liability is probable and measurable? So, okay. Now, we have here terms for probability and then measurability. So, these are the two. Probable, it should be probable and measurable. Okay? So, what if it's not probable or not measurable? Then, therefore, it is not to be recognized as a liability. Okay? Now, let's go here. Probable means the likeliness of an event to occur is greater than the probability that it will not occur. So, this means the likeliness that you will pay is 50%. Okay, the chances that you will pay an obligation is more than 50%. Okay, how about possible? The likeliness that you will pay a liability is equal to or less than 50%, but not less than 11. Okay, so 11 to this means 11 to 15% to 50%. Okay, 11 to 50%. So the probability that you will pay the liability is, okay, 11 to 50%. And then number 3, we have remote. Okay, if the probability is remote, then the liability is ignored. Okay, because the chances that you will pay is equal to or less than 10%. Okay, so it is negligible because the chances that it will happen is almost next to nothing. Okay, so if the probability is remote, the liability is ignored. Okay, what about possible? What about probable? So later we'll get to that. Okay, what about measurability? When we say measurability, it is measurable if there is a reliable estimate. Now, of course, now this is the least acceptable, kasi most liabilities, there is a determinable amount. If I borrow 50 pesos from you, okay, and then, what is my liability? 50 pesos. That is determinable. Okay, but what entails a reliable estimate? So, for a reliable estimate, you should consult with experts. So, let's say, for example, I have a company and then the workers went on a strike and then they filed a case against me. Now, there is a chance that I will lose. Okay? So, who do I have to talk to in order to know the estimated amount that I will pay? Okay? So I have to consult with a lawyer. Okay? What if I have a liability from tax implications? So whom do I have to talk to know the reliable estimate of liability? Then you have to talk to a CPA. Okay? Or an accountant for that matter. So, when we say reliable estimate, it's not exactly determinable, okay? It's okay if you cannot determine the exact amount, just as long as you have a reliable estimate. Now, if there is only one outcome, then the reliable estimate is based on the um, given parameters provided by the expert. But if there are multiple outcomes, okay, multiple estimated outcomes, okay, and all of them are possible or probable, then therefore you have to weigh them. So we call that weighted average. Okay, so what do you mean by weighted average? Um, let's say for example, the expert told you, oh, you have a 10% chance that you will pay 100 pesos. You have 50% chance to pay 200. You have 40% chance to pay, let's say for example, 150. So what is my reliable estimate there? So you compute for the weighted average. So 10% times 100, 10. 50%, 100, and then 40% times 15, this is 60. So therefore, my reliable estimate is 170. So this is what happens when there are multiple outcomes. Okay? And what was given to you is a range? So let's say for example, you ask your lawyer, oh, we have a case. So what is the estimated amount that we will have to pay? So let's say for example, the lawyer said, oh, 100 to 500. Okay? So so they gave us a range, no? So what will we do, no? So you go to the midpoint or the average. Okay, you go to the midpoint. So how do you get the midpoint? 'Di ba? 500 plus 600 plus 100 divided by 2. So that would give us 300. Okay? So that is a reliable estimate. Now, so there's a question a while ago. What do we call liabilities that are remote or possible? No. So let's check here. No. So you always check the probability. No. Probable, 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 possible, possible. As you can see there, I have not considered remote here because it's negligible. If it's remote, then ignore. Okay. Now, if the liability is probable and it is measurable, now and the measurable is determinable, then the recognition is an accrual. Okay? Is an accrual liability? Yes. Okay? These are accounts payable, notes payable. So they are probable, no? Because there is a certain date, and then it is measurable because it is determinable because the actual amount is provided in the contract itself. Okay? What about if it's probable and measurable but a reliable estimate? Do you recognize that? Yes, in the form of provisions. So, in a sense, provisions are estimated liabilities. So, what's the difference between the two? For accruals, the amount is determinable. For provisions, the account is just estimated. Okay? Are from estimates, rather. Okay? What if it's probable but not measurable? We call that contingent liability. What if vice versa? It is possible, so this means it is not probable, but it is measurable, contingent liability. And contingent liability is not recognized, rather it is disclosed. Okay? So, when we say disclosed, this means that it is provided in the notes to FS. Okay? Notes to financial statement. It is not included in the balance sheet, but it is included in the notes to financial statement. What if it's possible? This means it is not probable and not measurable. Ignore. Okay? Ignore it. Okay? Next, so that we have two classifications of liabilities, current and non-current. Okay? So number one, the entity expects to settle the liability within the normal operating cycle. So this is true with trade liabilities. Okay? Number 2, the entity holds the liability primarily for the purpose of trading. So these are liabilities arising from debt instruments. Okay? Debt instruments from investments. So let's say for example, someone invested in your company in the form of debt instruments. Okay? So you go here, no? So these are both for trade liabilities. Okay? So in any case, these two, A and B, these are for trade. Okay? The expectation as they are for trading. Okay? So normal operating cycle, or it is specifically designated that it is for trading. Okay? Number 2, the liability is due to be settled within 12 months after the period. So these liabilities are for non-trade liabilities. If the liability is non-trade, then therefore the 12-month rule will apply. Okay? So just a clarification, it doesn't mean that if it's 12 months, automatic trade. Okay? Or rather, if it's more than 12 months, it is automatically non-current. No. Okay? If the liability is trade, regardless of the period on when it is due, it is always current. For non-trade liabilities, you use the 12-month rule. Okay? Next, the entity does not have an unconditional right to defer settlement of the liability for up to 12 months of the reporting period. We will have a separate discussion for this. Okay? Because it is very confusing, but we have a way to what do you call this, to simplify that. Okay? Next, we have non-current liabilities, the second classification. There is no definition for non-current liabilities. So it is just a residual definition. This means that if the liability does not comply with the does not comply with one of the following, then therefore that is automatically non-current. Okay? Now, what about measurement? Okay? For the measurement of liabilities, now theoretically, liabilities are measured, initially measured at present value and subsequently measured at amortized cost. But in practice, that is not true. Okay? So of course, we go first with the reality. So for current liabilities, interest or non-interest bearing, the initial measurement is face amount and the subsequent measurement is face amount. So when we say face amount, it is the amount that is presented in the instrument itself or in the contract itself. For non-current liabilities, interest bearing is face amount and then subsequent measurement face amount. But for non-current liabilities that are non-interest bearing, the initial measurement is present value and the subsequent measurement is amortized cost. Okay? Now, if you can remember, this is the same scenario with assets. So, current assets, di ba? In interest or non-interest, face amount. And for non-current assets, interest-bearing, face amount. But for non-interest, present value and amortized cost. So, same scenario. Okay? Now, we go to the change in classification. Now, this is to further expand the condition in letter D of the current liabilities. So, change in application, the classification of a liability may be changed if there are events that affect, the initial classification. Okay, that affect the initial classification. These changes of classification will apply if, so this means that if there is a change in classification, so from current to non-current, so will I change or if there is an event that gives rise to the change in classification. So let's say, for example, the duration of the liability is changed from 12 months to from 1 year to 3 years. So there is a sudden change of classification. So from current, it should be transferred to non-current. So do we allow ourselves to change the classification from current to non-current? It depends. Okay? So when will that change apply? So the events affecting the classification was completed on or before the reporting period. So the change in classification should happen before the end of the reporting period. So in most cases, before December 31. So let's say, for example, you have a liability of 1 year, and then you have a refinancing agreement with your with the creditor, and then you ask him if you can extend the duration of the liability from 1 year to 3 years. Okay, so as you can see, by just looking at it, oh, I'm changing from current to non-current because there is an increase in term. So can I change the classification from current to non-current? It depends. So that change should happen before December 31. So if it was approved before, so let's say, for example, you requested that from 1 year you extend it to 3 years. If if it was approved before December 31, okay, then you apply the change. Okay? But if it was or if it was agreed after December 31, then you do not apply the change. Okay? So the liability will remain current. Okay? As of that date. Okay? So an illustration, so from 1 year you are going to extend it to 3 years, no, duration. So this is December 31. So let's say, for example, this is 2021 and this is 2022. Now the change applied, if the change applied here, then therefore you change the liability of 2021 from current to non-current. But if the change happened here, you retain the current classification of 2021. Yes, sir, it changed from 1 to 3 years. Is it right? Is it not that we will change it to non-current? Yes, you will change it to non-current, but you change it for the FS of 2022 and not 2021. Okay? For 2021, as far as 2021 is concerned, as of December 31, it didn't change. Okay? So, if the change happened here, okay, then you can amend 2021. Okay, so I will transfer that liability from current to non-current. But if the change happened here, then you do nothing of 2021. Okay? So that's the idea. Now there are some cases from non-current, it will be changed to current. So this is what happens in some cases where there are breach of covenant. Okay, so what are covenants? So these covenants are liabilities with condition. So they will provide you with that liability provided you adhere with their condition. Okay? So in some cases, there is a breach in covenant. It means that you did not comply with the condition set in the contract. So let's say, for example, you have loaned me 5 million and it will be paid for 5 years, provided that um, provided that I will pass the CPA board exam. Okay? Now, what if I didn't pass the CPA board exam? Then that 5 years, okay, will be decreased to on demand, meaning current. From non-current, it will be changed to current. Now, same rule applies. If that change happened before December 31, you apply the change. So from non-current, you change it to current. But if the liability if the liability only changed after, if the change applied happened after December 31, then you do not change nothing for the balance sheet date. Okay? And then number 2, the transaction or refinancing liability and the entity was given unconditional right or discretion to refinance the liability. So let's say, for example, when we say refinance, this is to change the duration, the date. Okay? So from 1 year, I can change it to 3 years, to 5 years. So I can increase the term. Now, if the company, let's say, for example, I borrowed money and, okay, per contract, I have the ability or I have the right to, okay, to change or refinance the liability for future periods. So this means that I have the right to extend its duration. So in that case, that liability is always non-current. Why? Because no one wants to pay a liability. Okay? So if I'm the one with liability, of course, since I don't want to pay liability, I will extend and extend and extend and extend. Okay? So that is for introduction to liabilities.